Hello everyone and welcome to another one of my investing videos where I try to simplify aspects of the markets and how they work. I would like to remind you that I am not a financial advisor. Anything I say here is for education and entertainment purposes only. You can and will lose money if you don't do your own research. In this video, I'm going to cover the basics of the stock market, what it is, and how it works. There is no one market. In fact, there are hundreds if not thousands of markets around the world. In the US, there are markets for securities, commodities, assets, and derivatives. These include stocks, options, cryptocurrency, bonds, forex, commodities, OTC, real estate, vehicles, art, and many other assets. Stocks allow you to take partial ownership of a company. Stock is represented by the number of shares a company has issued. The amount of ownership depends on how many shares of the company are available and how many you own. Stock is just a name used to represent the total amount of shares you own. For example, if a company has 10 shares and you buy 5 of them, you have a 50% stake or ownership in the company. You do not own 5 stock. You own stock in the amount of 5 shares. Another way of saying it is I own 5 shares and they make up the amount of stock I own in the company. Stock can be purchased as preferred or common stock. Common stock is what you usually buy in the stock market. These shares are bought and sold through stock exchanges. Price of the company's shares does not remain the same over time. It will fluctuate up and down based on supply and demand. A public offering, news events, and other catalysts can greatly affect the price of the company's share price. So why does a company have stock? A company issues stock through an initial public offering, also known as an IPO. A company will go public or initiate a public offering for various reasons. They might want to raise capital to pay off debt, invest in growth, fund research and development, and many other reasons. All the shares that can be publicly traded in the US make up the US stock market. Shares are traded on exchanges. These are places where individuals or institutions go and exchange ownership of the stock they own. There are several exchanges in the United States, but the two major exchanges in the US are the New York Stock Exchange and the NASDAQ. There are several methods investors use to gauge the performance of the market. A popular one is to track indices or compare a portfolio's performance to an index. The most widely used indices are the Dow Jones, which is composed of about 30 stocks, the S&P, which has about 500 stocks, and the NASDAQ Composite, which is made up of roughly 3,000 stocks. These indices cannot be traded directly, but there are index funds and exchange-traded funds that can track these indices and sectors within the market, and those can be traded. The stock market can be divided into 11 sectors. These are composed of groups of stocks that have a similar industry or product. Now you have a basic understanding of what makes up the stock market, but there are a few things to consider before just blindly throwing your money at the stock market. These include the type of investor someone wants to be, the risk tolerance someone has, the type of stock or equity they want to purchase, what makes a particular stock a good buy, and how to access the stock market. Investing style can be split into two types, passive and active. A passive investor is usually a hands-off, long-term investor that is not concerned with the day-to-day fluctuations in the market. Active investors are more hands-on. They try to beat the market and move within the momentum and volatility of a particular stock or equity. Active investing is considered by many to be the riskier investing style, especially if you're relatively new to the market. Stocks can be categorized into specific groups. The three main ones are value, growth, and income. Value stocks are companies that are trading at a particular price that is believed to be well below the market value. Growth stocks are typically made up of companies that are growing fast, usually seen as companies where the share price percentage is beating or believed to be able to beat the market. Income stocks are composed of companies that pay regular dividends to the stockholder. They normally have consistent increases to the dividend and are considered relatively safer than growth and value stocks. Stock and equity types are the kind of asset you can purchase and trade. They can fall within the three categories I just mentioned. Individual stocks are stocks that you can trade when you want to invest in just one company. Funds are comprised of a group of stocks. They can be made up from money pooled from investors or mimic and track the same performance as indices or a particular index, sector, commodity, or any other asset. Then you also have REITs or real estate investment trust, which is stock from a company that owns, operates, or finances income generating real estate. Stocks can be further classified into their company's market cap, which is the total value of all the shares a company has. For example, if a company has 100 shares and they are each valued at $5, its market cap is $500. Large cap companies have a market cap of 10 billion or more. Mid cap companies have a market cap of 2 billion to 10 billion. Small cap companies have a market cap between 300 million and 2 billion. And micro cap companies have a market cap of less than 300 million, but are usually not traded on the main exchanges. When purchasing stock, it's important to evaluate a few metrics before blindly going all in on company stocks. One should consider some of the risks associated with being involved in the stock market. And if coupled with good outlook, trading style, and strategy, an investor could have a good chance of being profitable. Buying shares of a company does not guarantee you will make money. In fact, statistics have shown that most new traders tend to lose money during their first days, weeks, months, and in some cases years. There's no one direct cause for this. If there was, we would all avoid it and be millionaires. But studies have shown that traders that are aware of the risk associated with a particular purchase and have developed a good strategy for navigating through the overall turbulence of the market have a better chance of being profitable than traders that purchase stock because someone just told them to do it without any research or knowledge of what they are doing. Risk can vary from stock to stock. Common risk an investor should consider for a particular stock or asset is liquidity, which is related to how often the shares of a company are traded and how easy it is for the investor to buy and sell their shares. Market direction is important because the market can go up, down, and stay relatively flat. A market shift can be sudden or take several months to resolve. Take the 2000 dot-com bubble. It shifted from an uptrend to a downtrend back to an uptrend and took about 8 years to recover. The 2008 financial crisis took about 5 years to recover. The 2018 taper tantrum took 7 months to recover, and even the 2020 COVID pandemic took several months to recover. This should not be confused with a market pullback, which are a healthy consolidation, price acceptance, and partial profit taking from short-term traders. Concentration of money means you put all your money in one company or asset. This is risky because bad press release, shift in investor sentiment, or any other factor can significantly impact your portfolio. By diversifying your portfolio, you help mitigate this risk. Inflation can affect the market and some companies more than others. High inflation tends to impact some stocks and sectors more than others also. Time horizon is related to how long you plan to hold a particular stock and the potential risk that could affect that. Companies borrow money and take on credit to help themselves grow and expand. Sometimes these companies go out of business or are forced to liquidate. The common shareholder is the last to get paid. It is possible that after a company is liquidated, there's nothing left to pay the shareholder and they are left with significant losses. Foreign influence can impact the markets. War, economic stability, or sanctions on a foreign country or companies can have a large effect in the world economy and overall markets. The effects are typically greater if you own foreign investments. One of the biggest risks is poor money management. I tend to believe that the job of the market is to go up over time and the job of the investors to prevent losses. Properly managing a position and knowing when to accept the loss because the share price has moved in the opposite direction than anticipated is critical to keeping your losses small. A proper strategy should be constructed before entering a position. When purchasing stock, it's important to know what is the overall performance outlook of that purchase. Is it going to be short-term or long-term? And also, what is the investor's comfort when it comes to trading style? Is he aggressive or passive? A good strategy will help bolster a trading style and improve the odds of being profitable. Fundamental analysis is the strategy mainly used by long-term investors or swing traders. This is where the investor will use ratios and percentages derived from company's income statement, balance sheet, and cash flow statement to produce a health assessment of a company and determine the intrinsic value or present value based on future-looking projections. Technical analysis uses past data and volume to determine the future direction of a stock. Technical analysis can be used with chart patterns, indicators, and trend lines along with price action to determine a good entry and exit for a particular trade. This method is primarily used by short-term traders. Trading psychology is considered a key component in an investor's decision-making process. Mental and emotional aspects such as greed, FOMO, regret, desire, conviction will come into play when an investor decides to buy or sell stock. If not controlled properly, it can lead to rash decisions and ultimately to failure as a trader in the market. Traders can combine any form of style and strategy to fit their objective. These are some common words that you can Google and get familiar with in order to help guide you in your trading. There are several places where you can purchase stocks. If your employer offers a stock purchase plan, you can get shares of your company that way. Some banks offer automated investing. And then there are brokerages, which simply put are businesses that act as a broker or a place where items, in this case stocks, can be exchanged. They provide access to the open markets. Some offer different tools and perks. People have different opinions on which is best. This is usually tied to the ease of use and trading style. I personally have different brokerages and each one has a specific use. If you are curious or interested in opening an account, see the description below for links to online brokerage companies that you can open up today and start your investing journey. If you found this information helpful and would like to see more videos like this or get notified when I release new videos, click the like, subscribe, and notification buttons. Leave a comment below if you would like to see a video on a specific topic. Thank you for watching and have a great trading week.